students, good morning and welcome back. So we'll continue with the illustrations on profit prior to incorporation. Okay, so take down this problem. So take down fast. Okay, if you're done with this, then there's a continuation on that. So this is the continuation. Okay, so we'll start with the solution. So first you have to find out, you have to work it out. That is the working note. That is you have to calculate the ratios. Okay, you have to calculate two ratios. One is sales ratio and the another one is your time ratios. Okay, now so before that you just note down this point. See here, sales up to 1st July 2019 7,500. So this is needed to calculate the ratios. Okay, so this is the problem. Anudeep Limited incorporated on 1st July 2019. What is the date of incorporation? 1st July 2019 and the closing date is 31st March. So, yes, so from April to it is July 1st. So, you have to take June. Why June? Because July 1st, after that it is incorporated. So, this is the pre-incorporation period. Means the date the it is the pre-incorporation period. Andre, when you got the incorporation certificate, that is on 1st July. So that is before that. The months before the certificate of incorporation you get, they are called as pre. After that, whatever the months the months you have operated, that is called post. So that is July, July to March. So now you write calculation of time ratio, or you can write time ratio. So first you have to write the working note. So write time ratio. Below that you write pre-incorporation period. Pre-incorporation period means the months which is before the incorporation of the companies. Okay. So from April to June, how many months? 3 months. So pre-incorporation period, 3 months. Next you write post-incorporation period. Post-incorporation period from July to March. So count the months from July to March. So it comes to 9 months. So the ratio is 3:9. So you simplify. 3 ones are 3. 3 ones are 3. 3 threes are 9. So it comes to 1:2. So the time ratio is 1:2. Sorry, 1:3. 1:3. That is the time ratio. So time ratio is done. So next you have to calculate the sales ratios, right? Sales ratio. Sales ratio. Okay, now you see here the total sale is 45,000. That is the total sale. Now you see the point number 3. Adjustment. So point number 3. Sales up to 1st July 2019, that is 7,500 included in sales, which is included in sales up to 1st July means that is the pre-incorporation sales. So my total sale is 45,000. In that 7,500 is the sale that is done at the time of pre-incorporation. The remaining, what is the remaining? That is 37,500. So 37,500 is the remaining sales, that is the post incorporation sale. Why? Because they have given it clearly that 7,500 it is included. If it is given that up to the incorporation date, that is 1st July 2009, if the sale is 7,500, then you can assume this as the post acquisition. If they give excluding 7,500, then 45,000 is the post, 7,500 is the pre. If they give including, then you have to divide. So your sales ratio, so 7,500 is to 37,500. So now you simplify 7,500 ones are 7,500 fives are. So the sales ratio is 1 is to 5. 1 is to 5. Okay, now we'll classify the item. So they have asked you to prepare the final accounts. Final accounts means you have to start from trading usually, but trading information you cannot apportion, so you have to start with the final P&L account. Okay, because sales, closing stock, purchases, you cannot apportion that figures. Gross profit you can apportion. Okay, now Anudeep Limited. Anudeep Limited incorporated on 1st July 2019 with the capital of 50,000 in equity shares of rupees 10 each, took over the running business of Mr. Anurag as from 1st April 2019. The purchase price was 20,000, was settled on 1st July together with the interest of 10% per annum by fully paid shares of 17,500 and the balance by the check. So the company trial balance as on 1st March 2020 was as follows. So they have given the trial balance. So first to classify the item, that is P&L item and balance sheet item. Okay. So then the P&L item, then we'll classify the ratios. The first one, that is cash at bank. So cash at bank is the balance sheet item. Share capital, balance sheet liability side. Land and building, balance sheet asset side. Fixtures, balance sheet asset side. Cycle is an asset. Okay, so balance sheet asset side. Now salary. Salary is the P&L item. Now what ratio you have to take? Salary is fixed, right? So the time ratio, timely payment you have to take. So the salary is a portion on the basis of 1:3. Purchases. Now purchases is required to calculate the gross profit, because you see the problem here, they have not given gross profit. So with the help of the trading item, first you have to calculate gross profit, then you have to apportion on the basis of the pre-incorporation and the post-incorporation. Okay. Now, so in the previous problem, you saw that pre-incorporation sale, post-incorporation sale, pre-incorporation purchase, post-incorporation purchase was given. So when that type of information is given, then you don't apply any ratios to calculate the gross profit. You can find the difference and you can write it as a pre as well as the post. That we done in the previous class, right? But in this problem, they have given the entire purchase. Sale you can, because you know, see the adjustment number 3, the pre-incorporation sale is given, post-incorporation sale you just now you calculated for the sales ratio. But what about the purchase? So you cannot follow that method. So the gross profit need to be apportioned on the basis of sales ratio. Okay. Next, so sale and purchase is required to calculate the gross profit. Debtors and creditor is the balance sheet item. Rent received. Rent received is the P&L item and the ratio is time ratio. Okay, it is a timely payment or the timely receipt. Now rent, rates and tax, again the P&L item on the basis of time, right? So time ratios. Building upkeep. Building upkeep means that is nothing but maintenance. Okay, we are maintaining the building. So it is again the timely basis. Okay, you have to fix the time, then you have to maintain it, right? It is not connected with the sale. So that is that to be a portion on the basis of time ratio. Director fees, you had the same thing in the previous class, right? Previous problem, director remuneration, it one and the same. So it is entire amount to be taken as post incorporation expenses, because directors are appointed after you form a company. So you understood this, right? Next we'll move on to the next information. Sundry charges, timely. Okay, sundry charges, time ratio. Interest paid. Okay, so there are a lot of confusion in interest paid. See, listen, if it is a debenture interest, then the entire amount is taken as the post incorporation. If the debenture interest, then the entire expenses is interest is taken as a post. If it is only interest or interest to vendors, outsiders, in that case you have to take the timely basis. Okay, you have to take the time ratio. On the basis of time ratio, you need to apportion the expenses. Okay, so the time ratio is 1:3. Next you see the prepare the final accounts. So first you have to calculate the gross profit because they have not given the gross profit. So first you have to calculate the gross profit, then you have to prepare the profit and loss account. So two amount column, pre-incorporation, post-incorporation on debit as well as credit. Then you have to prepare the consolidated balance sheet. Okay, final balance sheet. Now you see the additional information, stock at the end. So stock at the end, you know that adjustment you have to pass two entries, one in the balance sheet compulsory and the other one either in trading or in P&L account. Okay, I repeat, additional details you have to pass two entries, one in the balance sheet compulsory and the another one either in P&L account or in the trading account. Stock at the end, this is the closing stock. So once in the balance sheet compulsory, once in the balance sheet means this is an asset for you. Now in trading account, this closing stock is shown on the credit side. Bad debts, so once in the balance sheet you have to deduct from debtors. The second treatment in P&L account, debit side. On what ratio? Time ratio. Okay, sorry, on what ratio? You have to apportion the bad debts on time ratio. Sorry, bad debts is on the in the sales ratio. Okay, you have to apportion on the basis of sales ratio. So why? Because bad debt is nothing but irrecoverable money from the debtor. So debtor is connected with the sales, right? So when you sell the goods on credit, then the credit sale. So the bad debt is a portion on the basis of sales ratio. So including 50 on debtors taken over from the vendor means it is okay. So entire amount is a bad debt. So total 200. So nothing to do with this 50. So 50 has been included. If excluding means this 50 have to add here. Okay. Next, sales up to, you know that we took it for the calculation of sales ratio. Provide for doubtful debts 250. So balance sheet for debtors you have to deduct, and this you have to show on the in the your P&L account. And one more thing, provision is calculated on net profit. Okay, provision you keep it for from the net profit. Any provision you have to apportion from the net profit. So net profit means post incorporation profit. So post incorporation profit. Yeah. So this entire amount you have to take it on the post incorporation column. I repeat, provide for doubtful debts. Everything is done at the end of the financial year, not at the beginning. Okay, ಎಂಡಲ್ಲೇ ಇಡುವ provision ಅದು. It is calculated on the net debtor value and that is kept aside from the net profit. I repeat, provisions you keep at the end of the financial year and that too you calculate on the net value of the debtor. Debt value means after deducting everything from the debtor, means the ultimate net value of the debtor you get in the when there is a closing balance. During the closing of books of accounts. So everything is takes place at the post incorporation period, right? And another add-on point to that, provision is always kept aside from the net profit. So net profit means post incorporation period. So provide for doubtful debts, your entire amount you have to take under post incorporation column. Okay. Next, depreciation. So depreciation, that is on the basis of time ratios. Okay. So we'll start with the solution part. So first you write in the books of Anudeep Limited, profit and loss account for the year ending 31st March 2020, or you can write trading account for the year 2020. Okay. Then after trading account, you can give the heading P&L account for the year ending 31st March 2020. But first you have to calculate the gross profit because the gross profit is not given. So first you'll draw the lines for this trading account. Okay, so in this problem, there are three items which comes in the trading account, that is purchase, sales and closing stock. So this gross profit is the balancing figure. Okay, so this is the balancing figure. So gross profit is the balancing figure. Okay, so first you record purchases, that is two purchases 48,500, two purchases 48,500, then buy sales 45,000. The entire sales you have to take, because the purchase we don't know the pre-incorporation purchase and the post-incorporation purchase. So we took the entire purchase value, so you have to take the entire sales value. Then the closing stock, which is given in the adjustment. First information, addition information, first point. So the balancing figure, gross profit. Okay, next to draw the lines for P&L account. So 8 columns, 4 on the debit side, 4 on the credit side, 8 columns. So particulars, base or basis, pre-incorporation, post-incorporation. Particulars, basis, pre-incorporation, post-incorporation. Okay, now you see the problem, trial balance, which is the first P&L item, salaries. So write two salaries and the ratio, time ratio, 1:3. Salaries, then a portion on the basis of time ratio, 1:3. That is salaries. So next item, that is after salary purchases, we took in the trading account. Sales is done. Debtors and creditors is a balance sheet item. Rent received. Okay, before that you have to write by gross profit. Okay, sorry, I forgot to tell that. So you got this gross profit 10,500 in from the trading account, right? So first you have to write by gross profit, and which ratio you have to take? The sales ratio, 1:5. The sales ratio, because gross profit you calculate on the sales, or it is directly connected with the sales. So sales ratio. First you have to take the gross profit, then salaries, then rent. Okay, now you keep on recording the items, and you know the ratios, right? But you have to make two changes. There is a two error in this entire problem. One, the interest. So interest need to be apportioned on the basis of time ratio. That is 1:3. They are apportioned equally. Okay, you make some changes there. So 1000 you have to apportion on the basis of 1:3. It is not 500 and 500. Change that figure. And the second thing, the bad debt has been apportioned on the basis of sales time ratios. Actually, that need to be apportioned on the basis of sales ratios. So instead of 1:3, you make it 1:5 and you change the figure. Okay. So there were two changes you have to make in this entire problem. That is, first one, the interest need to be apportioned on the basis of time ratio. Here the time ratio is 1:1, sorry, 1:3, and the second one, that is the bad debts. So bad debt to be apportioned on the basis of sales ratio, that is 1:5. So that 200 you have to apportion on the basis of 1:5. Okay. After that you calculate the other thing, and you change the capital reserve. Okay, your capital reserve as well as the gross profit will change. So record all the expenses, all the liability, but when you record interest, that to pay a portion on the basis of 1:3. When you record bad debts, it should be a portion on the basis of 1:5. Okay. Then the depreciation, you directly calculate, apply the percentage on the asset, then a portion on the base of 1:3. Okay. So I will give 4 minutes. You do it fast. 4 minutes. So do it fast. So do it fast. Okay. So you'll get capital reserve of 1024 and the net profit of 5536. After making the correction, you will get this figure. Okay. So there's a mistake error in the total error in the difference also. Capital reserve, it is not 757, it comes to I think 1024. Net profit 5536. Okay. Still if you get the different figure, then you can contact me. I will check the answer. Okay. So after this, you have to draw the lines for balance sheet. If you're done with this, then you draw the draw the lines for balance sheet. You prepare the ledger account. So balance sheet as at or as on 31st March 2020. So draw the lines. Liabilities amount in rupees, assets amount in rupees. Okay, so which is the first item? You see the balance sheet. Either you can follow the liquidity method or you can follow the solvency method. Okay, so means either you can start with the current asset, then you can go for the fixed assets, or you can start with the fixed asset, then you can refer the current asset later also. So here they followed the solvency method. On the liability side, you can start with share capital, capital reserve, profit and loss. Then you can record all the long-term liabilities like debentures. There's a one format, okay? There's one format for the balance sheet where you start with the capital, you record all the reserves, then you record all the long-term liabilities like debentures, long-term loans, secured, unsecured loan. Then you record the all the current liabilities. On the asset side, you record all the fixed asset first, then the current assets. So now we'll follow the same method, solvency method. So first you have to record not the cash at bank. Cash at bank is the current asset. So that you have to record last. Next one, share capital. So liability side you write share capital and 22,500. Share capital 22,500. Okay, next one, the land and building. So land and building is a fixed asset, so you can record. So write the amount in the inner column because there is a depreciation. There's a depreciation. So land and building less depreciation, 8,000 minus 400, the net figure 7,600. Okay, next item, fixtures. Again, that is a fixed asset. So write fixtures 750. Fixtures 750. Okay, next, cycles. So there's a depreciation 20%. So cycles 1,000 less depreciation 200. So after cycle, salaries, purchase, sales, everything is done. So there is no other fixed assets. So now you can record the current assets and current liability. But before you record current liabilities, you have to record the reserves. Now you see the difference in the balance, sorry, in the P&L account. The pre-incorporation profit is called as capital profit and you have to transfer it to capital reserve, right? The pre-incorporation profit, you have to treat it as a capital profit, then you have to record it to capital reserve. Now you see the P&L account. So you got the capital profit, that is, see the pre-incorporation profit table. Pre-incorporation profit table. So you got something 1024, I think, right? 1024, I think. So that you have to record here. Okay. So 1024 you write here. 1024. Next you write profit and loss account. The post acquisition, post incorporation profit is called as revenue profit or net profit, which is transferred to profit and loss account. I repeat, pre incorporation profit is known as the capital profit. So that to be recorded or transferred to capital reserve, that we recorded here 1024. The post incorporation profit or the net profit, that is also known as net profit or revenue profit, that you have to record, that you have to transfer to P&L account. So here you write 5,536. It is not 5,803, 5,536. Okay, so liability side, first you start with capital, then you have to record reserves, that is capital reserve, general reserve, P&L account, revenue reserve, any reserve. Okay, profit and loss account. Then you have to record the long-term liabilities like debentures, long-term loan. So in this problem, there is no long-term loans. So now you record the current liabilities. On the asset side, you have to record the fixed asset first. So everything is done, right? Only 3 fixed asset is there in the problem. You all record it, and then remaining, that is current asset. So now we see the problem and record all the other remaining assets. So we see the first one. See the trial balance in that first item, cash at bank. So write cash at bank. You can change the position of current asset there itself. Okay, means after writing fixed asset, you can write any current asset first. It is not that you have to start with the closing stock. You can start with bank also. So cash at the bank. So that is the bank balance, right? At the bank. So 4,860. Share capital. Next item, share capital. We recorded land and building is done. Fixture is done. Cycle is done, right? Next, debtors and creditors. So now you write debtors. Debtors. So write amount in the inner column because we have two adjustment on that. Adjustment number 2 as well as adjustment number 4. You deduct both the figure. Less bad debts 200, less RBD. That is provision. Doubtful debt 250. So you have to deduct both the item. So write debtors 4500 less bad debts 200, it comes to 4300, less RBD 250, it comes to 4050. So creditors, there is no adjustment on creditors, so directly write the amount in the outer column, 3000. Okay, after debtors and creditors, next one, see the adjustment. So no other item in the trial balance, adjustment. There's a closing stock. So that is the last item. Then the other items we have already recorded. Closing stock 14,000. So now you do the total, your balance sheet will tally. Okay, so I wind up to discuss with this problem. So remaining we'll see after your the pending odd semester exam. Okay, so all the best for your exam. Thank you.